Global markets are mixed this morning ahead of key US inflation data. The RBA holds, softens on inflation, but continues to see a tight labour market. The Aussie and Kiwi dollars fall 1%. Australian consumer and business confidence both dip, and China's exports haven't experienced a pre-Trump bump yet. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim explains how the new Reserve Bank of India governor could approach monetary policy, including with a new deputy in place.
We think that this could decisively shift in the February meeting, and it could be even a majority vote for a rate cut, if not a unanimous one. But of course, that is subject to speculation about who will be the new deputy governor at the RBA.
But first, in 5 and 5 with ANZ, global stock and bond markets are mixed and essentially on hold this morning ahead of key US inflation data tonight. Locally, the focus was on the Reserve Bank of Australia's final rate-setting meeting for 2024. The decision to hold at 4.35% was expected. But as ANZ Head of Australian Economics Adam Boyton explains, the board did signal greater confidence inflation was moving sustainably towards target.
The clear thing that comes out is just a bit more confidence on the part of the board that the economy is evolving in line with their expectations. Important, I think, on that, or one that's moved them a bit more in a dovish direction, is that the Q3 GDP data last week were a little softer than the board thought. Now, I don't think that in and of itself, or that one data point, is important, but then it looks like the bank's taken that, and also the most recent wages data being a bit softer than expected. That together helps remove some of the upside risks to inflation that the board had been worried about.
The Aussie dollar fell through the day, following that shift by the RBA and a retracement from the previous day's excitement about the China stimulus news. In overnight trading, by 4 a.m. Sydney-Melbourne time, the Aussie dollar was down 1% at 63.74 US cents. The Kiwi went with it, down 1.1% at 57.98 US cents. The US dollar index was up 0.35%. Number 2. Adam says that while the RBA's stance on inflation raises the prospect of a February cut, he's still picking May. The strength of Australia's jobs market remains a concern.
Generally, the Reserve Bank sees the labour market as tight. That tightness has eased somewhat over the past year or so. More recently, there are some indicators, though, that have stabilised. That it could be calling into question, I guess, the extent to which we'll get a further easing in labour market conditions. Now, obviously, tomorrow we have the next set of labour market data, so the market will be focused very heavily on where the labour market data we get tomorrow go. But for the Reserve Bank, they're still thinking labour market conditions are tight.
Number 3. Both Australian consumer confidence last week and business confidence in November fell, adding to slightly softer sentiment yesterday. ANZ economist Maddie Dunk says the ANZ Roy Morgan Consumer Confidence Survey dipped 2.9 points as confidence about current financial conditions dropped.
In particular, people weren't feeling good about their financial conditions over the next 12 months. And last week we did have the GDP data out that came in a bit softer than expected. So potentially that was flowing through into how people were feeling about the economy and about the outlook more broadly. The other thing too is that we saw a drop in our time to buy a major household item sub-index, and that coincided with the conclusion of Black Friday sales events.
Number 4. Eyes have been on the oil prices in recent days after developments in Syria and the potential impact on Middle Eastern conflicts. At 4 a.m. Sydney-Melbourne time, the West Texas Intermediate oil price was up 0.9% at $69.92 US dollars a barrel. ANZ commodity strategist Sunny Kamari says traders are holding off large reactions to the events for now.
We have to be mindful that investors are not now cautious to react to any geopolitical events because there have been many, and the overall impact on oil market was negligible. So they are adopting a stance where they want to see it to believe it. So in our view, what could support oil prices from here is the latest OPEC's decision to delay its unwinding of production cuts, which is likely to remove 1 million barrel per day of oil from the market.
Number 5. China's exports grew 7.6% in November from a year ago. That was below the consensus forecast for around 9%. ANZ senior China strategist Xiaopeng Xing says the below expectation print may be due to the market overestimating when front-loading of exports ahead of Donald Trump's new tariffs would take place.
In fact, November export to the US only increased about 8%. I think the front-loading demand from the US may materialize in December and January. November was a little bit early because the shipment to the US were will require almost 1 month. So I expect the export number to go up in December again. I still expect another export peak in January for this export cycle.
Xiao Pangjing there. Now, in our bonus deep dive interview, ANZ Economist Dhiraj Nim analyses how India's new Reserve Bank governor might approach his new role.
Sanjay Malhotra, who is the current Revenue Secretary for the Union Government, will be the 26th governor. His appointment came amidst much speculation that the incumbent governor, Shaktikanta Das, would get another extension, but he did not. So Sanjay Malhotra has been a career bureaucrat with over 3 decades of experience in public policy in various capacities with the state and the central government. By the way of training, he is a computer science engineer from a very reputed institute in India, IIT Kanpur, and of course has also got a public policy degree from the Princeton University. In his prior positions, he's been engaged with the Ministry of Finance in various capacities. He's also been a secretary in the Department of Financial Services, which gives him a lot of experience in banking and financial regulation, making him a suitable candidate to run the Reserve Bank of India. Apart from that, of course, he's been very closely working with the finance minister in preparation of budgets and is very crucial, of course, to the fiscal policy making in New Delhi.
So what do we know about the new governor's views on growth, inflation, the currency, I guess, given his background or public statements to date?
Well, actually, not much. I mean, he's generally kept a low key as the revenue secretary, but we don't know much about what he thinks about growth and inflation in the economy. But what we do know is that the Ministry of Finance for quite some time has held a much less sanguine view of growth in the economy than the Reserve Bank of India. For example, Ministry of Finance thinks that growth in FY25, which is the fiscal year ending March 2025, would be close to about 6.5%, while the RBA was at 7% or higher until the previous meeting, not the December meeting, but the meeting before. They have recently revised down their growth forecast to 6.6%. Also, in the recent weeks, just before the last monetary policy meeting, we had heard the Commerce Minister and the Finance Minister publicly advocate for lower borrowing costs in the economy. And this was a first for Governor Shaktikanta Das since he resumed office close to about 6 years ago. So I think coming from that background, Sanjay Malhotra's thinking could be influenced by the government's view going into the February policy meeting. But I would refrain from categorizing him as strictly dovish or hawkish. We do think that India's monetary policy framework under the Monetary Policy Committee has matured over the years. And I think the future monetary policy decisions will solely be reliant upon the economic outlook and not so much the individual biases of the members.
There's also some more change coming at the Bank of India. I see the Deputy Governor, his term ends soon. So what kind of institution is the Governor inheriting in terms of its sort of institutional outlook on monetary policy and India's economy?
Look, the monetary policy in India is now decided by a 6-member monetary policy committee, of which both the Governor and the Deputy Governor are a part of. So the next thing to note would, of course, be who will replace the current Deputy Governor, Dr. Michael Patra, who's generally been hawkish in his economic commentary. So, of course, that composition change will have a bearing on how monetary policy decisions will be taken from here on. As of the last meeting, we know that 2 of the 3 external members of the Monetary Policy Committee were advocating for a rate cut, while all the RBI members, including the Governor and the Deputy Governor, were in favor of a rate hold. So we think that this could decisively shift in the February meeting, and it could be even a majority vote for a rate cut, if not a unanimous one. But of course, that is subject to speculation about who will be the new Deputy Governor at the RBI.
Would it also be subject to what happens to the currency in the meantime as well, just in terms of the geopolitical developments we're seeing going on following the US election, for instance?
Yes, I think rupee has been a concern because of its weakness in the recent weeks. What we are seeing is that after many years, India's pull factors for currency, which were strong growth and macro stability, are undergoing a bit of a change. For example, growth has slowed, inflation has proved to be a bit sticky, current account is widening even though it is manageable, but equity markets are correcting a bit. So this has reduced the appeal of Indian assets for foreign investors, which is also weighing on the rupee.
Dhiraj Nim. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, December the 11th. Catch you tomorrow with those key US inflation figures and what it could mean for the Fed. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.